Okay, can we start?
Yes, sir. Yes, sir. Sir.
Yeah. So we discussed about CRR, SLR and bank rate, right? So today we will complete the other quantitative measures. So we'll start with, you can give a heading, liquidity adjustment facility. Liquidity adjustment facility. Okay. So if you see here, let's say this is money supply and I take time here. Okay. So like money supply is going like this, coming down, going and remain stable, then going up, then coming stable. Okay, let me mark it as 2, 3, 4 different time periods. This is one, and this is second, this is T1, this is T2, this is stable T3, this is T4, like that. Okay, so on my x-axis I am taking time and y-axis I am taking money supply. So what do you think, which situations are abnormal here? Which situations are abnormal?
So between T1 and T2 and between T3 and T4.
This is abnormal situation. There is a huge fluctuation, right? So between T3, T4 also fluctuations are there. So what is the problem with T1, T2? T1, T2, if you see, what is the problem? Excess money supply or shortage of money supply?
It's a shortage of money supply.
So here you can see shortage of money supply. So what RBI need to do here?
So reduce the CRR, SLR.
Means you tell me, don't talk technically. If shortage is there, what RBI need to do?
They have to increase the money supply.
They need to, so in shortage, RBI have to infuse money, right? So RBI have to infuse money.
Yes.
So here T3, T4, Shivangi, your mic is on.
Reduce the money supply.
So T3, T4, it is excess money supply, right?
Yes.
So here it is excess. So what RBI need to do? RBI have to suck out, right? Suck out the money from the market, right? So let's not talk from CRR, SLR, bank rate point of view here. We will talk from repo and reverse repo. So repo is actually used in which situation?
Sir, shortage.
So here basically repo, here reverse repo. In general, I explained this, repo can be used in both cases also by increasing, decreasing. So if money supply or money is in short, you simply reduce the repo, that you can actually infuse money supply. Okay, so just keep this in mind and we are going to discuss about repo and reverse repo. Okay, so basically done for this purpose only, to increase and decrease money supply in the abnormal situations. Okay, so just give a heading, repo. Repo stands for repurchase operations or options. Repo. Repurchase options or operations. Under that you can write a definition and I'll explain that definition. Under a repo transaction, central bank purchases a short-term government security. Central bank purchases a short-term government security from banks or financial institutions. From banks or financial institutions with an agreement to sell them back at a predetermined rate and date. At a predetermined date and rate. So what I'm saying is, from bank, RBI purchase what? Government security, right? So RBI buy government security. So when RBI buy government security, what RBI will give? What RBI will give?
Money.
Money, rupee, okay. And what is the agreement? What is the agreement?
So predetermined rate and date.
At a predetermined rate and date, it will be repurchased. It has to be repurchased, right? Now RBI is buying the GSEC, but it has to be repurchased by the banks. So when the banks repurchase it, what bank need to do? Bank have to give money
To the RBI.
back to the RBI. So this is actually repo transaction. So RBI is purchasing the government security from banks and give money. And for this, there is an interest rate, right? That rate upon which this transaction is happening is what you call as repo rate. Okay, so the transaction, the rate of this transaction is what is called as repo rate. Now, if you see here, banks, otherwise also, just before we have discussed about bank rate. Bank rate also is same, right? Banks will give security to RBI and RBI give money. What is the difference between bank rate and government security? This what we are talking about, repo rate or repo transaction and bank rate? What is the difference?
So here government security is required. Here they are first class security.
Yeah, the difference is this only. Here banks can give only government security. The bank rate, the banks can borrow under first class security. Now, which one is more secure, government security or first class security?
Government securities.
Government security. So what do you think? Where will be the interest more?
First class securities.
So first class security is less secure, so you need to pay more interest. And that's the reason why bank rate is always above what? Repo rate. Okay? Is this okay? So this is usually short term, this is usually done for 2 weeks, fortnight. Okay, so you can write there what is repo rate. It is a rate of interest. It is a rate of interest at which the central bank lends. It is a rate of interest at which the central bank lends to banks or financial institutions, for short period of time against government securities. Okay. So the reason why now RBI will fix only repo rate, which is policy rate. Okay, so repo rate will be fixed. So let's say repo rate is fixed. What is the bank rate? Bank rate will be higher than that. So you can say bank rate actually equal to repo rate plus 0.5 percentage point. So if it is 4% repo rate, what will be the bank rate? 4.5 percentage, like this. Is this clear? What is the problem? If bank rate and repo rate both will be equal, what will be the problem? Do you think bank will borrow under repo rate? If both are equal, let's suppose bank rate is 4%, repo rate also 4%. So do you think bank will borrow under repo rate?
Yes, sir, bank will go for repo rate only.
Why?
As this is more secured.
For whom? Repo rate for whom or secure? You are pledging government security when you are borrowing under repo rate. You are pledging first class security when you are borrowing under bank rate. So which will you pledge? Your better security will pledge or the first class security will pledge?
Okay, yeah.
Yeah, you will pledge your first class security, right? So banks will borrow under bank rate only if both are equal. Banks will never borrow under repo rate because banks prefer to keep the government security with banks. So that is the reason why, and also this is not that secure. So repo rate is slightly less than bank rate. and repo rate will be always fixed. What is the difference between percentage and percentage point? So let's suppose if I'm saying, let's say CRR, this 4%. Okay, so if I'm saying percentage, what is 4, let's say 1% of this 4. Let's suppose if I'm saying percentage. Here if you see I've told you percentage point. Okay, so if I'm saying 1% of 4, what is that? 1% of 4 is what?
0.004.
Not 004, it is 0.04.
Yeah, 0.04.
Yeah. Okay, so if I'm saying 0.5%, what is that? Half of this? 0.02, right? 0.02? Okay, so if I'm saying bank rate equal to repo rate plus 0.5%, then what will be the rate? 4 is the repo rate and 4 plus 0.02, right? 4.02 should be the bank rate. If I go with percentage, you got it? But if I am saying percentage point, 1 percentage point means if this is 4, this is going to be 5. Or 1 percentage point means it is 100 basis point. Okay, so 1 percent point means 100 basis point. So that is why I can write here if 4%, if it is 0.5 percentage point, it is 50 basis points. So I can actually write 4.5%. This point, have you got it clear? So I won't say it is percentage, it is percentage point. Any doubt here? Many people have doubt here. So why I am saying this percentage point? If this is clear, then it is okay. When I am saying 0.5 percentage point, it is 50 basis point. When I am saying 1 percentage point, then 4 to 5 I can directly write. If I am saying 0.5 percentage point, I can say 4 to 4.5. But if I am simply saying 1%, you need to find what is 1%. This is 1%. This is 0.5%. So this will be the actual value. But that's not the case here. Here we are talking about percentage point. Clear? Confusion is there? Arey, talk something, say something. Okay.
No, sir.
So now let's suppose let's say 20% is your SLR requirement. Okay, 20% is your SLR requirement, and you have exactly this much government securities are there. Now can you borrow under repo rate? You have only 20% GSEC, and that is for your SLR. Can you borrow under repo?
No, sir.
You cannot borrow under repo. You cannot pledge the GSEC which is there in SLR. So if you remember yesterday, I have told you when you wrote SLR, I have told you unencumbered government security, right? Unencumbered means if you pledge this against any loan, that will not be counted as SLR. So if you are using some GSEC for repo rate or pledging with RBI, that will not be used under SLR. Is that clear?
So can you explain just once?
One more time. Yeah, okay. I'll say what I'm saying is you have some government security. If you are pledging that with RBI, here actually you are pledging and you are borrowing under repo transaction. So if that is with RBI, that will not be counted in SLR. So if you have only 20% your GSEC, only 20% GSEC and 20% is the SLR, so you cannot borrow under repo rate. So in which situation you can borrow under repo rate? If you have over and above the SLR requirement, if you have GSEC, then you can borrow under repo rate.
So what is the meaning of this unencumbered?
Unencumbered means it should not have been pledged with the RBI. If government securities pledged in RBI, that will not be counted in those government securities which is pledged with RBI will not be counted in SLR. That's what unencumbered securities. It should not be pledged. Those pledged securities will not be counted. Okay? Is this clear?
Okay, sir.
So basically banks, if they don't have extra government security, they cannot borrow under repo rate. So what is the choice? That is why bank rate is there. Now, even if you don't have government security, if you have a private security, you can pledge that and you can borrow under bank rate. But the point is, you need to pay some 0.5 basis point extra, 0.5 percentage point extra. Okay. And just because bank rate and repo rate are different, banks are borrowing under repo rate. If both are same, banks will not borrow under repo rate, because why you are pledging your government securities and why you are compromising your SLR requirements, etc. You can pledge the first class security if both are equal. So that is the logic why both are having different interest rates. 0.5 percentage point extra you need to pay for bank rate. Okay. So repo rate is actually the policy rate now. RBI will announce. Yeah, you can talk, Ashwin. I cannot read in between. It will be difficult. If possible, you can talk in between. No problem.
Sir, sorry to bother.
Yeah.
These policy rates, are they being determined on quarterly basis, sir?
Policy rates?
Are they being determined on quarterly basis or, I mean, like half yearly basis, sir?
Quarterly basis. The RBI will come up with this quarterly basis. Yes.
Okay, sir. Yes. Just had it out. Sir.
Okay.
Thanks.
So now repo is done. Can we go for reverse repo? So reverse repo is actually the opposite. Okay. So you can write there one definition. Under this, under reverse repo, under this, the central bank, under this, the central bank or RBI sells short-term government securities. Central bank or RBI sells short-term government security to banks with an agreement to purchase them back at a predetermined rate and date. At a predetermined rate and date. Okay, so what I'm saying is the government security only here, RBI will sell, right? What is the agreement? So what banks will give to RBI? Rupee, right? What is the agreement? It will be repurchased, right? That means there will be a buyback. So RBI will give rupee to bank. So this is what reverse repo. Okay, I missed out one thing over here. When we talked about repo, so repo rate increasing. What does that mean? Repo rate increasing means how will it affect the money supply?
So the money supply will reduce.
Yes, you can see here repo rate increasing. Do you think banks will borrow under repo? Any interest is increasing means logically you can think the borrowing will come down, right? So banks will borrow less. So banks will lend less also. Credit creation capacity will come down. Okay, no? So banks will get less money because of increase in repo. So credit creation will be less. Credit creation less means what is the money supply impact? Money supply will decrease. Money supply will decrease means purchasing power will decrease. That lead to decrease in aggregate demand. That lead to control in inflation. Inflation will come down or price level will come down. Automatically growth also will come down. So that is why we are always talking repo rate increase for decreasing or reducing inflation. But the problem is why government is against increase in repo rate, because growth will be affected. So growth is affected means unemployment, poverty and all those problems will be there. Okay, so repo rate increase can control inflation. How? Because you can reduce money supply. We will revisit this again in inflation. Inflation control measures will revisit. Okay, so here we are with the reverse repo. So I hope you understood this reverse repo. So some textbooks or some teachers, if you see, they will say that reverse repos, RBI borrows from bank. You can actually say in two ways, RBI borrow from bank, or secondly, bank keep their money with RBI. What do you think is better? What is better?
The second option.
Why second is better?
So because why would RBI take any loan?
Actually, what is the need for RBI to take loan from banks, right? So there is no point in saying, and these are some people at some point of time taught somebody, and it continued just like that. Repos, banks borrow from RBI, and reverse repos, the reverse. RBI borrow from banks. What is the point in RBI to borrow from banks? Is it required? You think logically, and when you speak, you think logically and speak. There is no point in RBI to borrow from banks. Even the textbook also tells this, that is a problem actually. So, but better to tell this, because when RBI is giving better interest, okay, why you keep this, why you are giving money to RBI? Because you get more interest. When the reverse repo is so high, actually bank give money to RBI. So it is because you are keeping it's like you are depositing your money in RBI. Okay, so it is better to say RBI or banks keep their money with RBI rather than RBI borrowing from bank. Obviously, it is done to suck out money supply. What will happen if reverse repo rate the rate at which this transaction is happening, that is what the reverse repo rate. You can write one line over there. It is a reverse repo rate. Heading reverse repo rate. One line. It is a rate of interest. It is the rate of interest at which banks can keep funds with the central bank. Banks can keep funds with the central bank. See, like we keep our fund with banks, no, and banks are paying certain interest. Similarly, here also, actually banks are not borrowing from us. We are depositing it in bank. Exactly the same way banks are keeping funds with RBI. That is a better way of interpretation of this reverse repo. That's why I am writing like this. Banks keep funds with central. You may see in some textbooks RBI borrow from banks, but okay, whatever it is, it's up to you to take it in whatever way you want. Both are okay. Banks can keep funds with the central bank for short period of time. Under a reverse repo transaction. Okay, so what you need to do here is what will happen if reverse repo is increasing? Let's suppose reverse repo rate is increasing. What will happen?
So money supply will reduce.
Why money supply is going to reduce? Because banks are getting more interest.
Yeah.
Banks are getting more interest if you keep money with RBI. So banks will be motivated to give money to RBI. So banks don't have money now because banks are getting higher interest from RBI. So what will happen? So banks will keep money with RBI, right? So when banks keep money with RBI, bank don't have money to lend. So credit creation capacity will be affected. That lead to decrease in money supply. Okay, so money supply will reduce. Then whatever we have discussed in case of other the repo, everything will be the same. So here money supply decrease, purchasing power decrease, aggregate demand decrease, price will decrease, and growth also will decrease. Okay. Now one thing people have always confusion is this: repo increase also lead to the same, reverse repo increase also lead to the same. Okay, just see the word is different, reverse, but that doesn't mean that you need to do the reverse operation. In both cases the operation is same. Repo increasing, money supply will reduce. Reverse repo increasing, still money supply will reduce. Okay, and I've told you repo is the policy rate, everything else is connected with the policy rate. So bank rate was how much? If you see bank rate, it is repo plus 0.5 percentage point, right? So what do you think reverse repo? Reverse repo will be more or less than repo? Logically, tell me logically.
Less than repo.
Why it is less?
Or else banks will always park their fund with RBI for higher interest rate. Like it's
No, not that. If reverse repo is less, what will happen is, or if reverse repo is less, if it is more, what will happen? If reverse repo is more, what will happen? Okay, for example, you are getting, let's say, you are depositing in bank. Okay, banks giving you interest, let's say 10% when you deposit. Okay, and you are getting fund from bank at 9%. What will happen here? You borrow from bank at 9% and you will deposit in bank at 10%, right? Yes or no?
Yes, sir.
That's exactly what is going to happen here. If reverse repo is less, if reverse repo is more, that means if repo is less, banks will borrow under repo rate and banks will deposit in reverse repo rate. So banks will get extra. Correct, no? So repo rate should be always less than the reverse repo should be less than repo. So reverse repo is actually repo minus 0.5 percentage point. You got this logic what I'm saying? What I'm saying is, imagine this case, some bank is offering you 10% interest if you deposit. Okay, if you deposit, you are getting 10% interest and banks are charging you 8% if you borrow. Then what you do? You will borrow at 8% and you deposit in the same bank at 10%, right? That's exactly what is going to happen if repo is, let's say 6% and reverse repo is 7%. You will borrow at repo and you will deposit at 7% through reverse repo. Ankita, is that clear?
Yes, sir.
Okay, so that is the reason why reverse repo is less than repo. If it is less, then this will not happen. Just like normal bank, when you borrow from bank, what is actually happening? Exactly the same. Okay. So is this
So what is the exact need of reverse repo?
Reverse repo means to suck out the money. Repo and reverse repo,
So
there are many instruments, but repo and reverse repo simultaneously function. No, see, for example, repo increase. What will happen? Money supply will decrease. For what is the reason? Why money supply is decreasing? Banks are not able to borrow because of high interest. Right? Correct, no? If repo is increasing, money supply decrease because banks are not able to borrow under a high interest. Similarly, when reverse repo increasing, there is a reverse impact. Now banks can keep money with RBI and RBI is giving you better interest. Why you are giving this to public? So bank themselves will opt to keep money with RBI when reverse repo is increasing. In that context also, money supply will decrease. See, when reverse repo is increasing, bank choose to keep money with RBI instead of lending to public because RBI is offering you better interest. So in that context,
it is still not clear to me.
when reverse repo is increasing, banks are getting more interest from RBI, correct?
Yes.
Yes, when banks are getting more interest from RBI, banks prefer to keep money with RBI.
Yes.
So RBI is giving more interest, you are keeping money, banks are keeping money with RBI. So banks have no money to lend outside. So money supply will decrease.
So this should essentially happen when banks have surplus funds, right?
Whatever it is, this will, see, both will work together, no? Both are connected and both will work together. So both working together, money supply will come down. On one side, your bank is not able to borrow. Secondly, bank is motivated to give money to RBI. Both are working simultaneously and effectively money supply is coming down.
Okay.
Not clear even now.
No, sir.
What is the problem?
So I'll ask in the ending.
Okay.
Finish the class.
Yeah. So you understood the logic why reverse repo is less than repo? Next is marginal standing facility, MSF. Okay, it is introduced in 2011. You can write 2011. It is an overdraft facility. Overdraft facility means you have a limit and you can borrow at any time, like that. Okay, and it is based on interest is daily basis interest. Interest is daily basis. Okay, its definition I'll tell you. Under MSF, you can write a definition. Under MSF, banks can borrow from RBI. Banks can borrow from RBI up to certain percentage. Up to certain percentage. Currently 2%. In bracket you can write currently 2% of their NDTL on overnight basis. Banks can borrow from RBI up to certain percentage of their NDTL deposits on overnight basis. Okay, interest charged on daily basis. One more line you write, this is more important, and this is how it differentiates from Repo and MSF. Okay, this line is very important. Banks have to pledge. What do you think? Which kind of security, first class or GSEC?
So GSEC?
Yeah, GSEC. Banks have to pledge government security. Banks have to pledge government security against such borrowing. But it does not affect their SLR requirements. It will not affect their SLR requirements. So can you tell me what is common in repo rate and MSF? What is common? You can borrow from RBI, right? And you need to give government security. What is the difference between SLR, not SLR, repo and MSF?
In MSF, SLR is not used for.
SLR requirement is not compromised in case of MSF, right?
Yes, sir.
Yeah. So what do you think? Which one you will have to pay more interest? MSF or repo?
So MSF.
MSF, because you get some relaxation in MSF, right? When there is relaxations, you need to pay more payment for that. So your SLR requirement is not compromised, so you need to pay more interest. So MSF is actually equal to repo rate plus 0.5 percentage point. Okay, so 0.5 percentage point. That means if repo is 4%, 4.5% is MSF. What about bank rate? What is bank rate? Repo rate plus, what is that? 0.5 percentage point. So both are same, right? Then what is the difference between MSF and bank rate?
So I think bank rate is long-term lending, sir. Bank rate is long-term lending.
Not long-term. The main difference is here private security. Here private company security and here government security. That is the main difference. Okay.
Sir, I read the definition from Ramesh Singh, sir. Bank rate, about bank rate. The interest rate which the RBI charges on its long-term lending is known as the bank rate.
I have given you the technical definition, and I've told you, if you see some textbooks, even reverse repo will be defined like RBI borrow from bank. So these all are guides, Technical definition is what I've given you in case of repo and reverse repo and bank rate and all.
Okay.
So you may not.
I just-
Why they have given us, because if you are writing in the guide, when it is going to help you in preparation, if they are writing that discounting, rediscounting, etc., then they also need to explain what is discounting, rediscounting. That in itself is a big effort. You understood? So you will stop reading those kinds of textbooks. What is the objective of those textbooks? It is basically to reduce the effort, and it is basically a guide. It is not a standard textbook.
Okay, sir.
Okay, so what I am giving you is the technical definition, and I can also explain each and every term. I have explained what is discounting, what is rediscounting, and here also in case of repo, reverse repo, I have explained each and every point. So I can tell that technical definition. So I hope you understood the difference. The technical difference and people's definitions are different. That is people's definition. RBI borrow from banks as reverse repo. These are people's definition, not the actual definition.
Okay, sir.
And same is the case with bank rate. So what I'm saying, the main difference is obviously this is slightly long term. I have told you 1 year, but again, can you say 1 year is a long term? It compared to repos for 2 weeks. So compared to that, it is long term, and compared to MSF also, it is long term. But you can't simply say it is long term. Again, based on comparison. Okay, so better always.
Excuse me, sir.
Yes, tell me, Ashwin.
I have a doubt, sir.
Yeah.
Sir, under MSF, you said that it is on overnight basis. So overnight basis is like in the sense like the banks which are borrowing, should they return back the loan on overnight basis?
See, banks, it is like overdraft facility given to banks upon their 2% of deposits that they have, NDTL. If some shortage is there today, banks can approach RBI and banks can borrow. That's what I mean by overnight basis they can do. And the interest also charged on daily basis.
Okay,
Now-
that means till the 2% of the NDTL, banks can borrow under marginal standing facility.
Yes, anytime they can borrow.
So after the 2%, they can either go in for repo or bank rate or whichever they find it.
No. See, up to 2. See, you have MSF and repo. Both options is there. But which one you prefer? Suppose you have both options, MSF and repo. Which one you will prefer?
MSF, no, sir. Sorry, repo.
You will prefer repo because you see here, interest is more for MSF.
Okay.
So why are you saying up to 2% I will borrow under MSF, then I'll go for repo? If possible, I'll go for repo completely. And if not possible with repo, then only I think of MSF. What is that situation where you cannot borrow under repo? What is the situation where you cannot borrow under repo?
Only when the government security.
When you don't have enough government security. So the role of MSF is what? Now you take the two situations. One situation, if you don't have extra government security, okay, unencumbered government security will not be counted in SLR. So if you don't have government security, you cannot borrow under repo rate. You cannot borrow under repo if you don't have extra.
Okay.
Secondly, bank rate, it is a discretion of RBI. You may not get it all the time. You go with any private security, it is not necessary. It is you cannot take it as granted. So bank rate is actually the discretion of RBI. So in case if bank is facing any problem, MSF could be also used by using the government security, but it will still be counted in SLR.
Okay, sir. Okay. Got it.
All this clear? What is the role of MSF? What is the need of M? See, the people may think that when bank rate is there, when repo is there, what is the need of MSF? There may be situation banks cannot borrow under repo. Which situation? When you don't have excess GSEC, you cannot borrow. Then bank rate is a discretion of RBI, so not necessarily you will get all the time going with all the any private security. So you can borrow under MSF upon your 2% NDTL, but for that you need to pay some extra interest.
Yes, sir.
And why paying extra interest? Because you are getting some concession. What is that concession? That your SLR requirement is not compromised. Okay. Yes. Tell me.
Private banks also borrow from repo.
Which one?
Do private banks borrow from repo?
Private banks borrow. Private banks can borrow. What is the problem? This is also regulated by RBI. All those requirements is followed. No.
Yes, sir.
Yeah. Okay, next is market stabilization scheme. Seventh one, no? So we talked about CRR, SLR, bank rate, repo rate, reverse repo rate, MSF. Now let me ask you, if you need to increase money supply, increase, or let's first talk about decrease money supply. For example, there is inflation. Now you need to control inflation. To control inflation, inflation is caused because of demand. So to reduce demand, what to do? You need to reduce money supply. So what is the objective of RBI now? Reduce money supply. So what operation will you do now?
To increase all policy rates.
All these you will increase, right? You will increase CRR. CRR increase will reduce money supply. SLR you increase. Bank rate you increase. Repo rate you will increase. Reverse repo rate you will increase. MSF you will increase. By increasing all these rates, you can reduce money supply. Now, if your objective is to promote growth, then what we need to do? Demand you need to increase. Aggregate demand you need to increase. For that you need to increase money supply. So what you will do here?
Decrease CRR, all policy rates.
You will reduce all the rates. Like you will reduce CRR, you will reduce SLR, you will reduce the bank rate, right? You will reduce the repo rate, you will reduce the reverse repo rate, you will reduce MSF. So this is what you will do in case of promotion of growth. And both cannot be achieved together. That is the key point. That's the monetary policy dilemma. If you control money supply, you will have to compromise growth. But you can achieve inflation targeting. If you focus on growth, you have to compromise on inflation. But what is the priority of RBI now?
Inflation control.
Inflation. After Urjit Patel committee 2014, we will discuss that committee when we discuss about inflation. So just keep that point in mind. So all these are clear, all these quantitative measures. One more is there, that's very simple, you can just write there, market stabilization scheme.
Sir, is this the open market operations?
Open market operation will come here.
Okay.
Market stabilization scheme. It was initiated in 2004. It was initiated in 2004. See, when we say open market operation, RBI will buy bonds and RBI will sell bonds. When will RBI buy bonds? Which situation? RBI buying bond means what? You are buying bonds from people, government securities. So what will be done?
It will pump the money into economy.
Yeah, RBI will pump the money. So if need to increase money supply, RBI will buy the bonds, right? If RBI need to decrease money supply, what RBI will do? Sell the bonds and suck out money supply, suck out money from market. So you can write here market stabilization scheme under this. It was initiated in 2004. Initiated in 2004. Under market stabilization scheme, RBI sell special government securities to
RBI sells
special government securities to suck out extra liquidity, created due to increase in forex reserve. I've told you when forex is coming, what is the impact? It will increase money supply. Equal amount of rupee has to be circulated in the market, right? So when forex is coming, it will increase money supply. And if you remember, I've told you post reform period, the reason for increasing money supply is because of forex, right? So to sterilize that impact, you can write there to increase what we have written. Yeah, to suck out extra liquidity. That means money supply created due to increase in forex reserve, to sterilize their inflationary impact, inflationary impact. The funds raised through sale of such bonds, the funds raised through the sale of such bonds are kept in a separate fund with RBI. Are kept in a separate fund with RBI. Okay, so that's about quantitative measures. Now we will see qualitative measures, that is selective measures. Few are there like this, and we will see. Yeah, tell me. Then the types of monetary policy: contractionary, expansionary, etc. And from that also last year question was asked, which type of monetary policy you will follow during this particular time, like that. Okay. So any doubts from this discussion?
Hello, sir.
Tell me.
Will the RBI pay any interest on the MSF separate fund?
No, RBI won't pay interest. RBI will charge interest.
Sir, in all above cases, when RBI sells securities, suck out the money from the market.
In this case.
And gives the money. In this case, and it gives the money to the government as a loan.
Yes.
So, but the RBI is gaining from the government.
No, RBI is not gaining anything. When you are buying the bonds, you are gaining something. See, I've told you how this is actually happening. It is through auction process, right? So when the government bond, let's say this is a bond, let's say the face value is 1,000, this is the government security. So RBI will sell or buy how? This is through auction. When RBI is buying back, it is based on the face value. But selling means what? Selling is based on auction process, right? So selling through to financial institutions, like I've told you, for SBI or ICICI or Punjab National Bank or HDFC Bank. So these people will offer, let's say 95, 94, 93, 92, etc. So RBI will sell to this person who is offering maximum. So this difference is the return, because when you're giving this bond back, you will get that 100 face value you will get, but you're buying at 95. So you are buying at a discount, and this is your return.
Okay. Sir, can the SLR requirement can be violated in MSF case?
Yes, SLR requirement can be violated in MSF, but not in repo. And since SLR requirement can be violated, that's why some extra interest you need to pay.
Yes.
Okay?
Thank you, sir.
Yeah. In case of MSF, you can pledge that government security which is counted in SLR also, not a problem. But in case of reverse repo rate, you cannot pledge that government security which is kept as SLR. You cannot compromise on SLR in case of repo, but you can do that in case of MSF. But only 2% you can get under MSF to meet that immediate problem. Okay. Any other doubts?
So what is the need of the separate government account for the separate fund with the RBI?
Which account?
Under MSS.
Yeah, I have told you, under MSF, what is the need for MSF? You're asking about why MSF
So not
is...
MSF, MSS. As in, why is the separate account maintained with the RBI?
Yeah, that is for providing it to government. MSS, okay, this market stabilization scheme. That fund will be used by the government.
Okay.
Hi, sir.
Yeah.
All these policy instruments are for short-term borrowing. Is there anything for long-term borrowing also, sir?
Long-term government bonds are there. That is long-term government bonds. Basically, dated securities. I'll talk about securities later when we discuss about capital market. These instruments are, you can say maybe bank rate, as somebody told, that Ramesh told that it is It is written as long term, but I won't say 1 year.
So your maximum is 1 year, no?
Yeah,
From zero.
that is 1 year. Yeah.
Okay, sir.
But where there are dated securities, long-term securities, etc. there that we will discuss later. In capital market, I'll discuss it.
Okay, sir.
What else?
Sorry to interrupt, sir.
Tell me, Ashwin.
Sir, with MC, marginal cost of funds lending rate, will it be covered under the chapter, sir?
Marginal cost of lending that I will cover here. A lot of variables are taken into consideration for lending purpose. Okay, deciding the interest and all. I'll discuss that. I think in the let me see that. No, not in this chapter. That comes under banking. The banking I have a different chapter. This is monetary policy, no? So these are monetary policy measures. Under banking, I will discuss that. Prime lending rate, etc. That's what you're talking about, right? Prime lending rate, MSLR, marginal standing. That I'll discuss in banking. Banking is a big module.
Okay.
I'll do that.
Thank you.
Yeah.
Okay. Thank you.
Can we stop here today?
Okay, sir.
Yeah.
Sure, sir.
We'll see tomorrow. See you.
Bye, sir.
Yeah.
Thank you, sir. Bye.